I'm Eric Eisenberg with Expert Home Loans. I'm a 25-year mortgage veteran and recently ranked one of the top 50 mortgage brokers in the USA. Here's an in-depth guide to conventional mortgages, giving you the information you need to make an informed decision before moving forward. A conventional mortgage is a loan that's bought by Fannie Mae, Freddie Mac, and those are government agencies. So basically, your bank is going to lend you the money, then they're going to turn around and sell your loan for a premium to government agencies, Fannie Mae and Freddie Mac. These government agencies come up with specific guidelines on which they will buy your loan, as far as income, credit score, property types, down payment options, and much more. First and most importantly is income. We always want to make sure that you can afford a mortgage payment before we lend you the money. Now, banks want to make sure that you have a 2-year history of income. If you're in the same industry and have worked multiple jobs over a 2-year period, you can still qualify based on your current salary. For self-employed individuals, we want to make sure that your business has been open and operating for 2 years minimum. Here's what we do. For wage earners, here's how we're going to calculate your income. We're going to take your current salary as of today moving forward and use that as your income calculation. For any bonuses, commissions, overtime, double overtime, or additional sources of income, we're going to average that out over the previous 2 years. So we're going to get proof from either you or your employer documenting those income sources over a 2-year period and average them out in order to add that additional income to get you qualified. For self-employed individuals that have had their business operating for between 2 and 5 years, we're going to use a 2-year average income. Now, keep in mind, we could add any depreciated income back into your calculations. If you've been self-employed for over 5 years, we could take the most recent year income and use that to get you qualified. As far as down payment is concerned, we want to see a minimum of 3%. Now, keep in mind, if you put down between 3 and 19%, you're going to be paying mortgage insurance. There's this preconceived connotation about mortgage insurance. Your uncle or your best friend or you read something that told you never to pay mortgage insurance. Let me tell you, mortgage insurance is a tool to get you into a home. It is very hard to save 20% down unless you received a gift, inheritance, or had a major liquidity event. For most people, they need to put money into their savings account from every paycheck in order to save enough for a down payment. Unless you're an extremely high income earner, it's going to be hard to outpace the real estate market. By the time you save 5% to 20%, that same home value could go up significantly where the difference won't even matter. Now, another huge tool you could utilize is you can get a gift from a family member in order to get a down payment. With housing prices the way they are, a lot of first-time home buyers cannot afford the full down payment to buy a home. If you have a family member willing to help you out and give you a gift for the down payment, we can use that. The final item is credit score. We want to make sure you have a history of paying your bills on time. The minimum requirement is a 620 credit score for a conventional mortgage. That's less than average. Now, typically, if you have a lower credit score, you're going to get a higher interest rate because the bank's considering you a higher risk loan. More recently, banks are waiving those additional rate adjustments for lower credit scores and lower down payments for first-time home buyers under a certain income amount that's decided by your county in order to get first-time home buyers into a home. Now, this is determined based on the income limits per county. If you're putting down less than 20% on a new home purchase, you're going to have to pay what's called mortgage insurance. Now, this is a type of insurance that the bank takes out on you personally in order to sell your loan to the government. The banks are always going to look at the worst case scenario. And this means that if your home does foreclose, the banks are going to get reimbursed the money that they laid out because they adhered to government specific guidelines. A lot of people are scared the second they hear mortgage insurance, but some banks are even offering lower rates for loans with mortgage insurance. I've personally closed loans at 81% financing rather than 80% financing in order to get a client mortgage insurance because they would get a lower rate for the remaining 30 years once that 1% difference was made up. A lot of people don't know this, but mortgage insurance doesn't automatically come off once you hit 20% equity in your home. Banks only remove the mortgage insurance once you hit 22% equity in your home based off the original purchase price. So if you buy $1 million property, once your loan balance becomes $780,000 or less, that's when the mortgage insurance will automatically come off. You can always make additional payments towards your principal balance to get that mortgage insurance off sooner. But remember, it's 80% when you're buying a home. It's 78% of your original purchase price when you already have that mortgage. Not only do you have to qualify for the mortgage, but the property also has to qualify for the mortgage. For condominiums, there are very specific guidelines regarding master insurance policies, HOAs, and the way that they handle their rules and regulations. The bank is also going to send out an independently ordered appraiser to your home to make sure that the value of your property is similar to the price you're paying for it. They do not want to lend more than what the value is worth. This also gives you an extra insurance policy that you're not overpaying for a home. If your appraisal comes in slightly lower than the purchase price, you have to look at outstanding circumstances. Maybe that's the market where you do have to overpay slightly for a home, as we saw in 2020 and 2021. At that point, there's still loan options available to you where you could either discuss lowering the price with the seller, which isn't always an option, or you could finance a higher amount based on the new appraised value or put additional funds out of your pocket. Another option to keep your out-of-pocket expenses as low as possible is to buy a multifamily property. Now, this has risks with a vacancy factor or if tenants don't pay rent. But if it works out properly, you can be collecting rent from tenants in a 2, 3, or 4 unit property in order to offset your mortgage payments. The level for entry on a multifamily property has always been significantly higher than a single-family home. But recently, Fannie Mae and Freddie Mac have adjusted guidelines. They're now allowing for 5% down on multifamily homes for qualified home buyers. The way it works as far as qualifying is their appraiser would determine the rental market value for those remaining units, and the bank will give you 75% of that and add that to your income. So if you have $4,000 of potential rental income on a multifamily unit for the units that you are not living in, the bank would give you an additional $3,000 towards your income in order to qualify you. The 25% that's removed from the rental income is called a vacancy factor. We know that there's going to be additional expenses, and at some points, that property will not always be rented out, so we want to adjust your income properly for that. There are 2 types of loan limits for conventional loans that are determined by county. You have the conforming loan limit, and then you have the high loan balance limit. These loan limits are adjusted every year by the FHFA based on real estate values. Typically, they're going up. Now, with conventional loans, you have multiple options as far as loan term. The standards are 15, 20, and 30 years. If you decide to borrow money with a lower loan term, such as 15 years, you're typically going to get a lower interest rate. With a 15-year mortgage, your payments will be higher because you're paying off your mortgage in half the time, but the amount of money that's going towards interest to the bank will be significantly lower. If you have the income to afford it, you should always look at 15-year loan options and make a comparison between the interest paid over a 15, 20, and 30-year term. Besides those standard terms, a lot of lenders are also allowing you to pick your term on your mortgage. They'll do 26, 27, 28, 29 years, or anything that you could decide. I don't typically recommend those mortgages to my clients because you don't get a benefit in interest rate for taking a 29-year term rather than a 30-year term. I always advise taking the 30-year term, which will obligate you to a lower monthly mortgage payment, and then if you want to make additional principal payments, you can do so and pay off your loan in a shorter term. So if you're not getting a benefit of taking a lower term, then don't obligate yourself to the higher payments. The way that mortgage interest works is you're always paying interest on the previous month's balance. So when you take out a mortgage, you have a set mortgage payment, which is your minimum monthly obligation that you owe to the bank. But if you are paying additional money towards principal, the amount of money that goes towards interest every month will be less and less because you're paying based on the previous month's mortgage balance. You can use that as a tool to your advantage, but remember, once you put the money in the home, it's very hard and very expensive to get it back out. One thing that's never talked about in the mortgage industry is a recast. Now, let's say that mortgage interest rates are the same or they go up and you want to pay a big chunk of money to your mortgage, minimum of $5,000. You could actually call up your loan servicer, tell them that you want to make a larger than expected mortgage payment and apply that towards your principal balance. Then tell them that you want to recast your loan. So what they're going to do is they're going to re-amortize your loan on the remaining term of your mortgage. So if you have 28 years and 10 months left on your mortgage, they're going to apply that large payment to your balance, and they're going to re-spread out your loan based on your current interest rate over the remaining term. Most banks charge a doc prep fee of $250 to $500 in order to do so. Believe it or not, with somebody with great credit scores, we've actually secured mortgage insurance as low as 0.1% of their loan. Conventional loans have a lot of benefits, but you need to always explore all options before making a decision. Remember, buying a home is a huge financial investment, and you need to know what you're doing and educate yourself about the process. To wrap it up, conventional loans will typically have lower interest rates, lower closing cost options, lower mortgage insurance options, and a variety of different loan terms. But remember, they will be stricter as far as down payment options, credit score requirements, and debt-to-income ratios than government-backed loans such as FHA and VA. So that's some basic information that you should know about conventional mortgages before applying for a loan. But that is just the tip of the iceberg. If you are looking at buying a home or applying for a conventional mortgage, always reach out to a mortgage expert, or you can reach out to me directly, Eric at experthomeloans.com.